In a major development shaking global geopolitics and financial markets, President Trump has announced the indefinite extension of the ceasefire with Iran just as it was set to expire. This unexpected reversal comes after the White House canceled planned peace talks in Islamabad and Iran refused to engage in further negotiations over the conflict. According to the latest CNN reporting, the United States military has significantly depleted its stockpiles of critical munitions during the recent intense war with Iran. Precision strike missiles have seen at least 45% of their inventory expended in the 7+ weeks of combat operations against Iranian targets. The United States has also used up nearly half of its interceptor missiles designed to counter ballistic threats and almost 50% of Patriot air defense systems. Tomahawk cruise missiles have experienced about 30% depletion, while other key long-range munitions show losses exceeding 20% of existing stocks in the arsenal. Experts warn that replenishing these vital weapons could take anywhere from 1 to 6 years given the current American manufacturing capabilities and ongoing supply chain challenges. This situation highlights the long-term consequences of U.S. manufacturing offshoring and misplaced defense spending priorities over the past several decades in national policy decisions. Retired Army Major Harrison Mann emphasized that politicians advocating for such conflicts appeared completely detached from the harsh reality of limited ammunition reserves and production rates. In stark contrast, Iran, backed by support from China and Russia, demonstrates much faster weapons generation capacity, making the conflict highly asymmetrical in terms of sustainability and endurance. The fragile nature of this ceasefire raises serious questions about whether it can hold once both sides have had time to rearm and resupply their forces effectively. President Trump may have had no real choice but to extend the agreement indefinitely to avoid immediate escalation amid critically low U.S. missile inventories right now. Markets are closely watching oil prices. CNN sources confirmed by Pentagon assessments reveal the U.S. remains seriously vulnerable to near-peer adversaries like China in any short-term conflict scenario ahead. This depletion affects not only direct operations, but also critical support for allies such as Israel and Ukraine, who rely on American munition supplies heavily. The Pentagon is now preparing urgent requests for supplemental congressional funding to begin the lengthy process of rebuilding these essential stockpiles after the heavy usage. However, the time required means America must navigate this period of reduced readiness with extreme caution regarding any potential renewed hostilities in the near future. Iran has shown remarkable resilience through recent maritime reversals and large delegations indicating complex internal decision-making processes within the Revolutionary Guard structure and leadership. Broader context includes significant economic leverage from China, which benefits from a distracted United States currently focused on Middle East instability and regional conflicts. Will this indefinite ceasefire represent a genuine path to de-escalation, or merely a pause before hostilities resume when military capabilities are restored on both sides? Financial analysts must closely consider how these military realities intersect with commodity markets and global energy security concerns going forward in the coming weeks. The interplay between depleted U.S. forces and Iranian alliances with major powers creates a complex strategic landscape for investors to monitor closely at this time. Yet this development sets the stage for deeper examination of specific market forecasts and scenarios outlined in leading investment research reports on the current situation. Those reports from Jefferies and J.P. Morgan expose exactly why Trump had no choice but to extend this ceasefire indefinitely, given America's critically depleted missile stockpiles right now. Jefferies maps a 70% base case for negotiations and a partial nuclear deal, but the 20 to 30% downside warns of public posturing followed by resumed diplomacy anyway. Their 15 to 20% tail risk scenario paints a nightmare of rapid return to war, where limited United States strikes trigger devastating Gulf infrastructure retaliation from Iran. And that is precisely why the depleted munitions crisis forced Trump's hand, because the Pentagon has burned through 45% of precision strike missiles in just weeks of fighting. J.P. Morgan details Iran's onshore storage capacity of 86 million barrels, with only 40 million left as working buffer, meaning roughly 22 days of exports at best. This oil clock ticks relentlessly while the United States lacks the ammunition to enforce a real blockade or sustain conflict, forcing this phony indefinite extension to buy time. Retired Major Harrison Mann nailed it when he exposed how our trillion-dollar defense budget serves as a slush fund for contractors like Raytheon and Lockheed instead of war readiness. We spent nearly $1 trillion last year on vanity projects like the F-35 fighter that Iran shot at on camera, yet we are out of real missiles. Ford-class carriers with broken toilets symbolize the rot in our military-industrial complex, while troops face black mold in barracks and depleted Patriot stocks everywhere. The hypocrisy is staggering as politicians detached from reality push this war knowing our stockpiles could not handle even a regional power like Iran for long. Meanwhile, Iran replenishes weapons faster with help from China and Russia, exposing the bitter fruits of decades of American manufacturing, offshoring, and strategic incompetence in Washington. Markets have already seen WTI hit $94 and Brent nearly touch 100 on fears of Strait of Hormuz closure, but the ceasefire buys only temporary calm. Goldman Sachs puts recession odds at 20%, modestly above baseline, yet a 3-month straight closure would trigger outright recession, according to top commodity traders' warnings. Retail sales posted a massive 1.7% jump, but do not be fooled, because the biggest driver was record gasoline spending, not healthy consumer demand at all. Final figures mask the pain as energy-driven inflation expectations push mortgage rates above 6.5%, squeezing homebuyers and revealing the fragile economic underbelly today. Kevin Warsh testified that core PCE is quite imperfect, and the balance sheet has played an unhelpful role, signaling potential major shifts in Fed policy frameworks ahead. This forced ceasefire extension reveals the ugly truth that our military is not the invincible force portrayed, while Iran probes workarounds like China-flagged tankers and gray market flows. Houthi forces on high alert at Bab el-Mandeb add another choke point wildcard that JP Morgan warns markets are underweighting in their supply shock calculations right now. The whipsaw announcements from the White House, one direction then reversal, have become the defining feature, exposing leadership chaos amid critically low ammunition reserves and production lags. Citi notes that global inventories will exit this conflict substantially lower than they entered it, raising the question of how much lower if the strait stays shut longer. Top traders like Gunvor, Trafigura, and Vitol warn that demand destruction could double next month to 5 million barrels per day, roughly 5% of global supply. All this military weakness means the consumer is being squeezed harder than the strong retail print suggests, as energy prices distort the real picture of economic health. The Jefferies structural read on Iran's Revolutionary Guard divisions shows slow decisions but eventual consensus, making any pause in fighting merely a tactical reset for Tehran. Yet even as Trump buys time with this extension, the underlying tensions and depleted stockpiles set up a powder keg for markets when the next crisis inevitably erupts soon. That powder keg means investors should brace for extreme volatility across oils and the dollar if Tehran refuses to honor this extension any longer. Jefferies' tail risk of limited United States strikes triggering Gulf infrastructure retaliation could ignite precisely because our depleted stockpiles prevent sustained military pressure right now. JP Morgan's oil clock exposes the brutal timeline with Iran down to 22 days of export buffer, forcing Trump into this indefinite pause to avoid total supply shock.
Yet once both sides rearm, America will face the harsh reality that our manufacturing decline leaves us unable to match Iranian production speed backed by China and Russia. Watch WTI and Brent surge again as global inventories draw down severely if the strait stays shut beyond April, according to Citi's stark warning on this conflict. Top traders warn demand destruction could double next month to 5 million barrels daily, roughly 5% of global supply, sending recession fears skyrocketing higher.
Ticking louder, exposing hypocrisies in Washington claims of American military supremacy. When those two forces stop aligning, the adjustment will not be gradual but sudden and punishing for portfolios unprepared for renewed Middle East chaos. Broader consequences include heightened recession odds at Goldman Sachs' 20% level if this phony ceasefire collapses under the weight of rearmament realities ahead. Houthi alerts at Bab el-Mandeb add the wild card that JP Morgan says markets are dangerously underweighting in their current supply shock calculations right now. Iran's Revolutionary Guard internal dynamics ensure eventual consensus on retaliation, making any pause merely tactical, while America scrambles for supplemental funding too late. Investors must monitor the Bank of Japan meeting and Treasury yields closely as dollar dynamics shift amid this forced de-escalation and Fed policy signals. The devastating truth is our trillion-dollar budgets built vanity projects instead of missiles, leaving us strategically crippled against even regional adversaries like Iran. This event proves the long-term fruits of offshoring and elite detachment have finally manifested in real time, forcing presidential weakness on the world stage. Forward-looking, the ceasefire extension offers short-term market calm but sets up the ultimate test when depleted stockpiles meet Iranian resilience in coming months. Financial security demands preparing for higher oil prices, lower inventories, and squeezed consumers as the military-industrial complex failures come home to roost now. America's global position weakens further while Beijing gains from our Middle East distraction, highlighting the urgent need for honest reckoning on defense priorities. The powder keg will explode again, and when it does, markets will demand answers about why we entered this war so unprepared and at such enormous cost. This synthesis of depleted munitions and investment forecasts delivers a sobering wake-up call for every investor navigating these treacherous waters ahead. The real question remains whether Washington learns from this humiliation or doubles down on the same failed policies that left our arsenal empty and our future uncertain.